get into today's presentation. The financial services industry is yet again under fire, and it should be. This is based off of Jason Nickerson's most recent CNY C-Suite magazine sponsored feature, available in the spring 2023 edition. And again, a full link to that article will be available to you in the chat feature. And for those of you that don't already, we are pretty active on social media. You can follow JGUA at the channels below. We do have a YouTube channel. You can find us at JGUA. Instagram at JGUA_HQ. That same handle is also used on Twitter. LinkedIn, just search John G. Ullman and Associates and you'll find us there. And Facebook, you'll find us at JGUA HQ. To keep up on the latest content that we're producing on a near daily basis, including videos, podcasts, and blogs. And just a brief introduction for our presenter today, Jason Nickerson, our newly appointed, recently promoted president and chief operating officer. Jason also recently celebrated his 25th anniversary with the firm. And before we get underway today, just wanted to go through a brief disclosure before we start today's presentation. The information discussed in this webinar is current as of the date noted and is for informational purposes only and does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, legal, or tax advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality. And with that, I will turn things over to Jason to get into today's webinar. Jason, take it away.
Well, thank you, Ryan. We should start with really what the foundation of the article was, and really 2 points around that. One, recent events in the banking industry has got me frustrated, and I'm sure many of you out there, consumers of financial services, are maybe frustrated or anxious over what has happened, and you should be. That's very appropriate because at least I'm feeling a bit of deja vu looking back to what we've experienced not too many years ago. But also, I hold the opinion that our personal financial matters, our personal financial lives, rank probably second in our life priority list. And when I say that, if you think about what are the real priorities in your life or family's life, probably number one is our mental and physical health. And then again, my opinion is number two is probably our personal family financial health. And so when something like has happened in the banking and financial industry happens, especially when it's happened seemingly now again, when it has happened before in the not too distant past, I get frustrated and I get passionate, for those consumers of financial services as well as myself. I'm a consumer of financial services and our clients. And so that was really sort of the genesis of the article. And if you haven't read it, I encourage you to read it. But we're going to cover a number of things because as I rolled my frustration forward, it turned into more frustration over some things that are used and talked about in financial services that I think really kind of need to be addressed. So foundationally, let's talk about really the starting point of this is a couple of bank failures and then some other discussion around companies that have been talked about as a result of what has happened with Silicon Valley Bank and Signature Bank. So if you haven't read, and I'm sure, the media has covered this so well, what really happened, the starting point was Silicon Valley Bank, a bank that had a business model serving a what I would call a volatile community, right? So the community they were working with was startup companies or tech startup companies, and they offered depositors probably higher than average deposit rates so they could turn around and loan the money back out to these to these companies and others. And we came to find out that some investment decisions by the bank, not necessarily related to those loans, but because of circumstances in the economy where interest rates were being raised by the feds, caused some on the book losses by Silicon Valley Bank, which sparked an essential run on the bank, and caused then the federal government to step in and really ensure all deposits. Okay, and so this is really the starting point. And then it rolled into Signature Bank, and then there were other companies being talked about in the same vein: First Republic, Credit Suisse, and even Charles Schwab. And Charles Schwab, we tend not to associate them with the banking world. They do have banking functions, but here's the spread, right? Is the first four names up there are banks, and Charles Schwab we tend to look at as custodians or managers of our 401ks, or we use them for our investment accounts like IRAs and to buy ETFs and mutual funds and stocks and bonds. So here's the spread now to financial services, and in the article, I start the article, or when are we really going to learn? Because the biggest frustrating point is not the fact that the bank failed. It is the fact that the federal government had to step in and ensure all deposits, even those above the FDIC limit. Okay. And the FDIC is an insurance program backed by the federal government and has certain limits where, as individuals, we can have our deposits insured up to $250,000. And if it's a jointly owned account, $500,000, and so on. So, there is some responsibility back on our part as consumers to understand those limits, or have a professional walking alongside us help understand those limits and where our risk really lies. And when the federal government steps in and covers this type of risk, ultimately that falls back on us as taxpayers, because the main revenue source for the federal government is our tax dollars, and here they are investing it to cover what are potentially some bad decisions, both by the bank and us as consumers. And so ultimately, what we'll get to is the fact that we need to take back the power of choice and take back some responsibility in this, or have a partner that walks alongside us that helps make those good decisions. And so that's really the starting point of this discussion, and the article today really has to do with the banks. So let's move on from this. First, let's understand that bank failures do happen from time to time, right? So we only have to go back to 2020 to find bank failures prior to this year, and there were 4 total. But really, where the frustrating point is, if we all sort of remember going through the Great Recession, which was 2007 to 2009, and the peak years of 08 and 09, we saw 165 bank failures, and we lost some big names in financial services like Bear Stearns and Lehman Brothers. And so it does happen, but there are things that we can do, good choices, better choices that we can make to protect ourselves, because these situations, as shown here, do happen from time to time, but it does feel a little bit like deja vu. So let's get to the next points that sort of started causing the frustration in the writing of the article. And that's a couple of phrases that I feel like today are being used as more marketing than they are reality. It really started with the first one, fiduciary duty, and we'll get into that a little bit. But then as starting to explore the frustration a bit, I see other terminology that is being used that just really isn't accurate and appropriate. So fiduciary duty, if we look at that and try to define it. Now, the financial services industry has adopted a definition of that, but if we look at the actual definition of fiduciary duty from a dictionary, you see a real key word that is used time and again, and that's trust. Okay. So in financial services, there's a more extensive definition of fiduciary. And I think that in a lot of cases, this is being misused and held out more as marketing, right? That financial services companies in general are advertising themselves as fiduciaries when I wonder if that it really is the case. So let's get into that a little bit more and explore that now in the conversation of what happened in the banking industry. Are banks fiduciaries? And do they have fiduciary duty to customers? Well, technically, the answer is no, if you can believe it or not, that banks don't meet the definition, the financial services industry definition of fiduciary duty, even though we trust them heavily with our pieces, major pieces of our personal financial lives, our deposits, the cash that we want readily available, to pay our bills, to keep the household running, to feed our families, and so on. So they don't meet that, but it doesn't mean that they shouldn't sort of act in that regard, right? Because this is, for many of us starting out in our financial lives, this is the core foundation, the core industry that we tap to work with to manage a piece of our financial lives. So, in my opinion, what can help stop this bank runs and having not only depositors harmed by decisions that banks are making, but also what can have us take back the power of choice and to help us and maybe have them act in a fiduciary way, but not maybe meeting the full definition of fiduciary duty. Well, first of all, we all understand banks are businesses, right? They have profits to make to keep shareholders happy. And unfortunately, we're never going to get them fully over to the side of the depositors, but have them start thinking more and more like depositors. Am I making the right investment decision because the depositors have trusted me with their money if I'm a bank? Okay. So that's step number one. In my opinion, banks can think more like a depositor versus how do I maximize revenue? And I feel strongly about this because, again, the very close tie with the federal government as well, right? So we trust them initially with our money, with our deposit needs to be readily available, but also we have this deep ingrained tie back to the federal government, and then that also falls back on us as customers and as taxpayers. So instead of being so focused on how much money can I loan these funds out for, how much revenue can I gather from that? Am I making the best and safest investment decisions for my depositors if they want their money back? So step one. Step two, very easy. Why not proactively warn your depositors when they are over the FDIC limit? And that would have avoided what the federal government had to do, which is step in with Silicon Valley Bank and ensure all deposits, even those above the FDIC limit. Simply have a regular, consistent communication to those that have more than the FDIC limit on deposit with the bank. They don't even have to offer suggestions of what to do next. But there are many different banking institutions and credit unions that all have this type of insurance coverage. And then even beyond that, there are ways to invest money, say in treasury bonds that have the backing of the federal government, which would be similar, not the same, similar to FDIC limits. Okay. So fiduciary duty, banks don't meet that definition, but maybe they should take a few steps to think a little bit differently to avoid the frustration and the anxiety on us as consumers of their services. But let's explore the fiduciary duty a little bit more. And I could provide a very technical definition that has been developed by the regulatory agencies. But my favorite metaphor for this, for fiduciary duty, is actually by one of my industry heroes, Michael Kitces, and he uses another term. He brings another term into the conversation to help define fiduciary duty, and it's a term known as suitability. And he says suitability is simply selling a suit that fits you. So if I sell you a suit, it may fit you, it may have the right sleeve length, the right pant length, right shoulder width, but it is an orange plaid mixed with a neon green pant or something, right? So picture that in your mind. It doesn't look good, but it really fits you well. Fiduciary duty means that not only does the suit have to fit you, it has to look good on you as well, right? For someone like me, I want it to look slimming. I know that's very hard to do, and they don't make suits that are that slimming, but it has to look good on you. The colors have to match. It has to be the right size. So fiduciary duty goes beyond what I think is being marketed. You have a lot of financial services companies saying, yes, we are a fiduciary because we are providing you a product or service that we can make the case fits you. But even from a structural standpoint, they don't get to know you well enough to really fully understand if this tool, this resource, this policy, this product, this service really fits into the whole financial picture, right? The thing that I opine is the second most important thing in our lives, the second highest priority. Does the partner that you're working with really fully understand everything that that means? Okay. So again, fiduciary duty best described as it fits and it looks good and it will support whatever goals and objectives for a period of time. So then when I started thinking about that and rolling it forward, and you're all starting to understand that the way my creative side of my mind works is that it can be, really a bag of monkeys, if you will. Then I start looking at comprehensive wealth management, because if you're really going to fulfill the fiduciary duty, can you call yourself a comprehensive wealth advisor, or are you acting in that capacity? You almost have to be, in my opinion, right? So what is comprehensive wealth management? Well, we're finding companies throw this around and throw this phrase around, and they're really not living by it. A comprehensive wealth manager really gets to know you first. It is way, way beyond a set of statements and balances in your investment accounts and bank accounts and so on. This is really getting to understand you and what it is that you need out of that partnership, out of that relationship. So they need to get to know you, the past decisions that you've made, the decisions that you need to make, and how you arrived at making those decisions. And what is the future vision? What are the goals look like? These are two questions. These two first bullets have zero to do with me asking anybody, how much do you have in your bank account, or how much do you have in investments, or what insurance policies do you own? It's really understanding how have you moved through life to this point where I'm meeting and talking to you, and how do you want to move at least for the next number of years, say 5 years. I always tell clients that we're going to look out 5 years, and we can certainly look out further, but as human beings, we don't have a real solid ability around projecting accurately anyway past that 5 year mark. But this is what comprehensive really means, right? Is starting with these top two things and then developing a set of options and strategies and providing education. Now, this is where a lot of that data, financial data, whether it's insurances or estate documents or bank account balances, investment account balances, this is where you really have to start to bring this into the fold anyway. So that information is extremely important. But from a standpoint of, am I providing comprehensive services, I really kind of need to understand what created all of this to begin with, because the account balances and the policies, those are results of prior decision making and a projection of where you want to go. So I need to get an understanding of that. But then if someone is acting truly in a comprehensive way, they're also walking alongside you through implementation. So they're understanding you, they're understanding where you are now, where you've been, where you are now, where you want to go. They help develop a set of options and strategies, and they help educate you. They turn the decision making over to you. They may say, hey, this is what we would suggest, but what's your decision? And then they help you with implementation. Okay. And this is all without necessarily any consideration for what they're being paid for, in my opinion, right? Is that these options and strategies and the advice and the range of advice they're giving should be absent what they're being paid on, right? So that's how you really know if they are managing your wealth versus just managing a piece of your money. And then ongoing evaluation, as I just said, that we really can't accurately as humans project beyond, say, 5 years. We can try, and that should be a part of our ongoing financial planning work, but we're not going to necessarily be accurate. So you have to have an evaluation process as well. How many times and how frequently are you going to step back and assess the path that you're on and the vision you have, and change the options and strategies and become re-educated in terms of what those decisions really mean. It can't just be, here is a plan, here is a product, and you'll never talk to me again, because that may not be a forever solid decision that fits within your plan. And overall, this process that you work on with this partner, or even for yourself, this should create peace of mind, because it is very holistic. It is, again, not just about the dollars and cents. This has much more to do on the behavioral side, the decisions you're making, and where you see yourself going from this point forward. Okay. Then again, my monkey brain continues forward, and we move on to the next topic, because one of the other conversations that we have with clients is really about cost. Now, understand that someone who is truly acting in a fiduciary duty for you, and someone who is providing this extensive set of services and advice to you, that it may not come cheap. And so the metaphor, or the similarity I draw, is going back up the priority list to the number one priority. And if our mental and physical health, if you agree with me that that is number one on the list, think about a time where you or a friend or family member had to have surgery. And at what point was the question of cost? At what point in that conversation did you ask, how much is this going to cost me? It may never have come up ever in the conversation with the surgeon. Your questions may have been more around, how many times have you had this surgery? How many times have you done it? How frequently do you do it? What's the best time of day for you? Because I want you awake and alert, Mrs. Doctor, to perform the surgery on me. How many nurses or other aides are you going to have in the room with you? Where am I going? How modern is the technology? What's the after process look like? What's the recovery look like? So there is a several list of questions that comes before even asking the doctor, how much are you going to charge me for this? And I know most of the time that isn't even a question, because how many times are you going to shop for a surgery that's cheap versus one that gets you back up and on your feet right away? So if you agree that your personal and family financial health is second behind your mental and physical health, why would that conversation be any different? Now, I'm not saying that you should overpay, but you should certainly understand the cost and the services being provided, and it may not be cheap. It may not be what your friends and family use, because situations are all different. You may decide, going back to the metaphor of the surgeon, there may be a surgery that you're having, let's say on your knee, and someone else needed surgery on another part of their body, and you wouldn't necessarily want to go to the same surgeon, right? Because your situations are different. It may not be the most popular choice or the one with the best marketing. So, in this conversation around consumption of financial services, it's really understanding, who is it that's on your side and what are they providing you? And is that what you really need? Is that the relationship you want? And again, that may not come cheap. And cost, while it should be a part of the conversation, it shouldn't be a main determining factor, because these relationships, they are very important and handle a key part of our priorities. So now, coming back to how I entered the article, if you read it, it really starts with when are we going to learn about how to make better decisions and how to maintain some of this responsibility? Because clearly, if you look at just the banking industry, or if you go back to 2008 and 2009, when we lost companies like Bear Stearns and Lehman Brothers, the decision making on their part isn't always necessarily in our best interest. It's always not in the sense of the fiduciary duty. And they're not here to make sure that our personal financial lives are well taken care of, right? So really need to understand that, which means we have to return and take back some of this responsibility and power back on us, and understand what it is that we need and who best fills those needs, right? So when I talk about the responsibilities, it's one, we have a fiscal responsibility to us and our families to, if this truly is the second highest priority in our list, then we have a responsibility to maintain significant fiscal health. It doesn't mean the most money. It just means being secure in our ability to pay the bills and feed our families and keep a home and things like that, right? But in the sense that we do need help, when we come to that realization, and it's not, we work with a lot of people, and I always tell them, it's not a knowledge necessarily, it's not an intelligence question. It's what have you chose to focus your life on, and it's not necessarily this facet of your life. It's not necessarily financial planning and investments and so on. So, in the sense of when we realize that we do need help, it's a responsibility on us to seek the help and guidance that we need, defining what it is we need, and then see and taking adequate time and to find the right partner, right? And so, therefore, we have a responsibility to be knowledgeable. Now, knowledgeable in the sense that if we do need help, we can certainly delegate some of that requirement onto the person that we're partnering with to help manage our financial lives, but we need to know that they're knowledgeable, and not just knowledgeable about the product or service that they're selling, but our financial lives. This is about us, right? And so this is what I mean, going back to the comment that there are financial services companies out there that aren't focused on us, and this is our responsibility to be knowledgeable or find a partner that is knowledgeable. And then we need to retain a couple of key powers. First of all, power of choice. It's about the only thing in our control in our lives is our choice, our reasoned choice. So the power to choose, what we do with our money, who to partner with, and in the sense of, let's say, the banking industry, where Silicon Valley Bank had to be fully bailed out, all those deposits had to be bailed out. We have a choice to be knowledgeable, a responsibility to be knowledgeable about what FDIC limits are. We don't need to memorize them, we can look them up, but then choose to say, I don't need to take that risk, right? To have deposits more than the FDIC limit, as an example. And then the last power that I would say is your power to make a change. Again, our lives are incredibly dynamic, probably more so today than ever before. And that's because the amount of options that are available to us. So we need to retain the power to make changes. I also mentioned that we really can't project much further than 5 years out. And so we want to retain the power not only to change, but to keep the cost of change low. So to not commit ourselves to services and products that cost a lot of money to get out and make a change when circumstances change, right? And having the power of choice and having the power of change, that's really what financial freedom is about. It again, it's not about the balances, it's about retaining those powers, and the ability to make the choice to begin with, but also to be able to make the change as our circumstances change and not have it cost us a lot of money. Why would we lock ourselves into a product or service that will maintain a cost if we do change out 7, 8, 9, 10 years, when I've already said we really don't have the ability to project out past 5 years. Okay. So this was really the basis and the foundation of the article and the talk today, and hopefully you're getting the sense that of frustration but passion about what financial services should mean to you, and you need to define that for yourself, right? So I turn the question over to the group. Would love to hear answers into our chat box, or maybe some of those answers create questions that we can further answer. But what does fiduciary duty really mean to you? What is it that you're looking for in the relationship, and have as a warm blanket, so to speak, that makes you feel comfortable that you are with the right institution, with the right partner? What does it mean to have comprehensive wealth management? Define the services that you really need. What responsibilities and choices are you going to retain, and what type of partner do you need to fulfill that definition of comprehensive wealth management? And do you even really understand it? Have you taken the time to step back and think about your financial relationships, and are they fulfilling? Are they meeting all your needs? And do you understand what your needs are to even begin with? So those are questions that you need to start answering for yourself. And again, because if we look at history, both over the last several weeks and even going back a few years, financial institutions, not all financial institutions or financial partners, are going to be looking out for you and doing what's best for you. And you need to retain that power.